Most traders begin their education accepting a gentle lie that has destroyed more fortunes than any single market crash. That prices move through random chaos. That institutional money operates in shadows beyond detection. And that successful speculation requires either supernatural intuition or algorithmic precision unavailable to individual participants. This fundamental misunderstanding transforms intelligent people into perpetual victims, applying sophisticated tools to solve the wrong problem entirely, while the market's most important secrets hide in plain sight. Richard Wyckoff discovered that markets cannot conceal their deepest truths because the very nature of large-scale operations makes invisibility impossible. When institutional money moves, it must move with purpose, preparation, and systematic execution that leaves unmistakable evidence across every chart. Behind every significant market campaign stands what Wyckoff termed the composite man. Not a single individual, but the collective intelligence representing all smart money operators who, despite their sophistication and resources, cannot accumulate massive positions or distribute enormous holdings without creating observable patterns that trained eyes can recognize and interpret. The first golden rule that governs all successful market analysis demands reading every price movement as if one brilliant mind orchestrates the entire operation. This perspective transforms chaotic price action into coherent campaigns with identifiable phases, predictable tactics, and measurable objectives. The composite man must accumulate before he can mark up, must distribute before he can mark down, and must test the resolve of opposing forces before committing significant capital to any direction. These requirements create footprints that appear consistently across all markets, all time frames, and all historical periods. Consider the mathematical reality confronting any large operator attempting to establish substantial positions. Institutional money cannot simply appear and purchase millions of shares without driving prices against their interests. Instead, they must conduct careful campaigns spanning weeks or months, absorbing selling pressure during accumulation phases, while building the cause necessary to justify subsequent effects. The sheer size of these operations requires range construction, volume absorption, false breakouts designed to trigger stops, and deliberate tests that reveal the true supply and demand balance underlying apparent price action. This understanding naturally reveals the second golden rule. Price and volume must be read together because price alone tells stories, while price with volume tells the truth. The composite man's genuine intentions appear not in isolated price movements but in the relationship between effort expended and results achieved. A narrow spread on massive volume signals absorption hands willing to take the other side when the crowd sells. A euphoric breakout that cannot extend despite promotion reveals distribution hands willing to supply shares to late buyers. These are footprints, and they appear because they must. The crowd reads headlines while the composite man reads inventory. He does not chase breakouts or panic at sell-offs. He builds cause, measures it systematically, and then permits effect to unfold naturally. The disciplined trader follows identical logic because hope destroys capital and argument with the tape represents pure vanity. One does not negotiate with a thermometer during fever. One reads the vital signs and treats the underlying condition. Risk becomes not a monster to fear but a premium to pay like fire insurance, ensuring that one mistake remains small, one lesson stays affordable, and one campaign survives to reach its objective. There emerges a quiet confidence when charts stop being battlefields of opinion and become transcripts of behavior. Traders recall specific moments, price surging on headlines yet traveling nowhere, violent sell-offs that could not make new lows, sudden shakeouts that reversed within minutes and never offered those prices again. If high volume producing minimal price movement has ever felt familiar, if apparent strength somehow disappointed or apparent weakness refused to follow through, the footprints were always visible. The question becomes not whether they exist, but how precisely to read them with enough discipline to act on logic rather than emotion. Extract asymmetry from structure, and let the tape teach what it has always been willing to reveal. Most traders accept a fundamental deception that transforms intelligent analysis into emotional gambling. That volume represents mere noise, that price tells the complete story, and that successful speculation depends upon predicting direction rather than diagnosing condition. This misunderstanding creates perpetual frustration as sophisticated individuals apply complex indicators to solve the wrong problem entirely, missing the market's most reliable signal hiding within every transaction. Richard Wyckoff positioned a single law at the center of his methodology because it transforms chaotic price action into readable conversation. He called it effort versus result, and it operates with scientific consistency across every market, every time frame, and every historical period. Effort represents the energy applied by market participants, volume, intensity, participation. Result represents the outcome achieved, price spread, progress, follow-through. When these elements align proportionally, markets display healthy character. When they diverge, the tape signals that underlying supply and demand balance has shifted even before price advertises the change. When effort and result diverge, expect a change of character. This principle transforms chart reading from subjective interpretation into objective diagnosis, providing the intellectual framework necessary to distinguish genuine moves from temporary deceptions. Massive volume producing minimal price movement signals absorption, large hands quietly taking the other side of frantic orders while building positions. The crowd sees a breakout attempt. The disciplined analyst recognizes distribution in real time. Someone absorbed that buying pressure without permitting price to advance, demonstrating both willingness and capacity to supply shares at these levels. The reverse scenario proves equally revealing. Price advances steadily on declining volume, creating broad spreads with minimal effort. No opposition appears because no significant hands choose to sell at these levels. The composite man either supports the advance or remains absent entirely, permitting natural price discovery to operate without interference. These conditions often precede accelerated moves as markets recognize the absence of resistance. Volume must be treated as the market's voice because it represents the only objective measure of conviction behind price movements. Price can be manipulated temporarily through small transactions at critical moments, but volume cannot lie about participation intensity. A narrow rally printed on heavy turnover does not express strength. It exposes the willingness of strong holders to supply inventory to urgent buyers. Conversely, broad, decisive price movement on light volume often declares lack of opposition, no meaningful supply in a rally, no genuine demand in a decline. The systematic approach requires treating these relationships like medical diagnosis rather than entertainment. Price provides symptoms, the patient's complaints about direction and momentum. Volume provides vital signs, objective measurements revealing true condition, regardless of subjective reports. A patient claiming perfect health while displaying fever and elevated pulse requires treatment based on vital signs rather than verbal assurances. Markets operate identically. Apparent strength accompanied by volume exhaustion demands caution despite bullish narratives, while apparent weakness accompanied by volume absorption suggests opportunity despite bearish sentiment. This diagnostic framework creates intellectual safety in an arena designed to exploit emotional reactions. The effort-result relationship provides anchor points immune to manipulation by news cycles, analyst opinions, or social media sentiment. Change of character becomes the critical signal separating continuation from reversal, genuine moves from false moves, sustainable trends from temporary deceptions. When effort and result align, expect continuation within established character. When they diverge, prepare for transformation, as underlying balance shifts toward new equilibrium. The beauty of this law lies in its universal application and mathematical certainty. Whether analyzing individual stocks, commodities, currencies, or indices, the effort-result relationship operates with consistent reliability because the underlying mathematics of large-scale operations remain constant. The composite man cannot escape the requirement to accumulate before markup or distribute before markdown, and these activities must leave proportional evidence in the permanent record. The disciplined trader learns to recognize these shifts before they become obvious to the crowd, positioning for probability rather than reacting to completed events, reading the market's voice rather than arguing with its verdict. The moment charts transform from chaotic candles into staged campaigns, trading becomes systematic rather than speculative. Every significant move emerges from identifiable preparation, and the composite man's accumulation campaigns unfold through predictable architecture that reveals itself to disciplined observation. The critical insight demands identifying market phase before making any decision, because actions taken without phase context represent pure gambling regardless of analytical sophistication. Accumulation begins with preliminary support, where institutional buying first meets desperate selling, establishing the initial floor that prevents further decline. This develops into selling climax conditions where panic reaches maximum intensity, often accompanied by news events that justify emotional capitulation, while smart money absorbs inventory at wholesale prices. The automatic rally follows naturally as bargain hunters emerge and short covering begins, demonstrating that genuine demand exists at these lower levels. Secondary tests probe the climax low without matching its intensity, revealing whether selling pressure has been genuinely absorbed or merely temporarily exhausted. The critical spring represents the composite man's most cunning maneuver, a deliberate shakeout below established support designed to trigger stop losses and create final panic selling that allows completion of accumulation at optimal prices. Operating at the danger point revolutionizes position management by requiring traders to identify locations where risk remains minimal while reward potential maximizes. Rather than chasing apparent strength, sophisticated operators position themselves where the campaign would clearly fail if analysis proves incorrect. This approach ensures stops remain small, logic stays clean, and asymmetric reward becomes mathematically probable. Springs and upthrusts serve as tests rather than trends, requiring successful retests before commitment. These false moves represent final examinations of market sentiment, separating weak holders from strong holders before significant moves begin. The successful spring rejects lower levels swiftly and refuses to revisit them, while accumulation transforms from horizontal congestion into vertical opportunity through systematic absorption of supply. The composite man's distribution campaign unfolds as accumulations, a mirror image, written in identical structural language but spoken through entirely different psychology. Where accumulation thrives on manufactured fear and desperate selling, distribution requires manufactured euphoria and desperate buying. The institutional operator possesses inventory acquired at wholesale prices during accumulation, and mathematical reality demands systematic liquidation into willing hands rather than hasty dumping that would destroy favorable pricing. Distribution begins with buying climax conditions where optimism reaches fever pitch and final buyers enter with maximum conviction, often coinciding with positive news events that justify emotional commitment. While smart money quietly supplies inventory at retail prices, the spreads widen dramatically on heavy volume, yet gains begin to stall despite maximum public effort. This represents the first diagnostic signal. Enormous energy, producing minimal result, suggests absorption by patient sellers, rather than genuine strength, demanding higher prices. The automatic reaction follows naturally as profit-taking emerges and momentum buyers discover insufficient follow-through, demonstrating that supply now exceeds demand at these elevated levels. Secondary tests return toward the climax highs, typically displaying narrower spreads and diminished authority, revealing whether buying pressure remains genuine or whether large, methodical sellers now control every upward thrust. The tape speaks clearly to those trained in its language. Volume swells, but price refuses to advance proportionally. The final act presents the upthrust after distribution, a brief and often violent push above established resistance that harvests, stops, recruits late buyers, and completes the composite man's sales campaign. The breakout appears victorious while the tape declares otherwise. What seemed like liberation above resistance collapses back into the range, as apparent strength proves merely the last inducement required to complete distribution at premium prices. Character has changed, though headlines celebrate continuation. Wyckoff's third law transforms subjective price targets into objective campaign measurements through the mathematical relationship between cause and effect. Horizontal preparation during distribution phases determines vertical potential during subsequent markdown, following quantifiable principles rather than emotional guesswork. The broader and longer the distribution range, the greater the energy stored for release during the markdown campaign that must follow. Point and figure counting converts this preparation into numerical projections, translating columns of congestion into measurable distances that price can reasonably travel once support yields to selling pressure. This mathematical precision ensures that major distribution campaigns possess sufficient energy to reach their projected objectives, preventing premature moves that would expose institutional intentions before completion of the transfer process. Each unit across the distribution range represents inventory methodically transferred from strong hands to weak hands, and each unit multiplies into distance that price will travel when the composite man stops defending his former accumulation levels. Successful campaigning demands alignment with this systematic approach rather than opposition to revealed structure. After signs of weakness emerge following distribution, rallies back toward broken support, provide optimal locations for initiating or adding to short positions, positioning where risk remains minimal and reward potential expands dramatically. The disciplined trader learns to sell the composite man's manufactured euphoria during distribution phases, just as he learned to buy manufactured fear during accumulation. The professional operates at danger points, where stops live just beyond levels. The composite man already tested and rejected, ensuring that invalidation signals remain clear, while asymmetric reward becomes mathematically probable. This transforms trading from emotional speculation into calculated participation in campaigns that unfold according to time-tested principles governing large-scale market operations, measured in ranges, expressed through tests, and executed with surgical precision when market structure declares the path of least resistance. The cruelest paradox in financial markets emerges when technical mastery meets psychological sabotage, creating the most dangerous trader of all, one who recognizes the composite man's footprints, yet destroys opportunities through emotional weakness, who identifies danger points, yet abandons them during temporary adversity, who understands campaign architecture yet acts against structural evidence when hope, fear, and ego overwhelm disciplined logic. The hardest battlefield lies not within the chart but within the mind that reads it, because the tape demands moral courage long before it rewards intellectual clarity. 3 archetypal failures defeat technical understanding with mathematical predictability, each representing a different emotional poison that transforms systematic analysis into reactive gambling. The breakout chaser. Driven by greed disguised as opportunity recognition, mistakes the composite man's upthrust after distribution for genuine strength, buying euphoria precisely when smart money distributes inventory to desperate participants. This trader enters at the worst possible mathematical moment after campaigns complete, rather than during their methodical construction, discovering too late that apparent movement lacked proportional meaning and that the reversal was structurally inevitable. The range denier cannot tolerate the horizontal price action that represents the composite man's most critical work, trading frantically inside accumulation zones, where testing and preparation unfold according to systematic requirements, driven by impatience that mistakes deliberate cause building for market indecision. This trader gets chopped by normal spring actions and secondary tests, abandoning positions just before significant moves emerge from completed preparation. What appears as random noise to the impatient eye reveals itself as methodical campaign construction to those willing to read the tape's patient language. The averager embodies ego's most destructive manifestation, widening stops and adding to losing positions against clear structural evidence, because admitting analytical error feels psychologically intolerable. This trader transforms manageable tuition payments into account-threatening disasters, choosing emotional comfort over capital preservation, personal opinion over market verdict, stubborn hope over systematic discipline. The mathematics become brutal. Small, planned losses compound into large, unplanned catastrophes when structure declares one direction, while emotion demands another. Wyckoff taught that discipline represents moral choice rather than mere technical preference, because the market offers identical information to every participant. Yet only those with sufficient character development can act systematically when emotions demand otherwise. The tape reveals truth through effort-result relationships, volume signatures, and structural tests. But the trader must choose whether to accept that objective revelation or argue with its undeniable verdict. This choice separates systematic campaigners from reactive speculators more decisively than any analytical technique. The path toward transformation requires recognizing that natural human instincts align perfectly against profitable trading, precisely when the composite man operates most actively. Hope sustains losing positions beyond their logical danger points. Fear prevents entries at optimal low-risk locations, and greed demands premature action or excessive position size. These emotional responses serve the composite man's requirements for campaign completion, providing the liquidity necessary for his systematic accumulation and distribution activities. Successful execution demands treating discipline as systematic procedure rather than personality trait. The campaign must be written before it is traded, with phase identification preceding every decision. Danger points specified before entry. Structural stops placed beyond tested levels, and confirmation requirements defined in advance. Each position lives or dies according to predetermined logic rather than in the moment emotion, with exits triggered by market structure rather than psychological discomfort. Losses transform from emotional failures into educational receipts. Small, acceptable, and pre-priced investments in systematic competence. The disciplined trader learns to journal each decision using the precise language of Wyckoff events: selling climax, automatic rally, secondary test, spring, sign of strength, sign of weakness, upthrust after distribution, last point of support, last point of supply. This vocabulary creates intellectual distance from emotional attachment, grading execution quality rather than outcome luck, building pattern recognition through systematic review rather than subjective interpretation. What emerges through this systematic approach is not bravado but quiet competence, the professional habit of letting logic outvote emotion while the tape renders its inevitable verdict. The transformation is complete when small, frequent losses feel like insurance premiums rather than personal defeats, when patience during cause-building phases feels natural rather than forced, and when alignment with the composite man's systematic approach replaces the exhausting battle against market structure that destroys so many technically capable yet emotionally undisciplined participants. The transformation from reactive participant to systematic campaigner culminates not in a dramatic revelation, but in the quiet elevation of proven principles into daily ritual. Mastery emerges when the 10 golden rules cease being intellectual concepts and become the disciplined framework governing every market engagement, creating the systematic foundation that separates sustainable success from temporary victories achieved through luck rather than logic. The work begins before any position consideration, with eyes trained to recognize the composite man's campaign architecture rather than chase individual price movements. Phase classification provides the essential foundation, determining whether accumulation or distribution dominates the current environment and dictating the strategic approach. This diagnostic lens reveals effort-result divergences that signal character changes before they become obvious to the crowd, positioning the disciplined trader to act on structural evidence rather than react to completed events. Every potential engagement must pass systematic evaluation. Danger point identification, where risk remains minimal, and the composite man's campaign would clearly fail if analysis proves incorrect. Confirmation requirements through signs of strength or weakness that prevent premature action, and mathematical projections based on cause-effect relationships that replace emotional price targets with objective campaign measurements. Entries occur only at locations where stops live just beyond tested structural levels, while position management follows predetermined scripts that add during pullbacks to structure and reduce at logical resistance points. The professional executes mechanically according to written rules rather than momentary emotions, treating each decision as conditional statement rather than predictive forecast. If structure declares accumulation, then risk lives near tested lows. If distribution dominates, then opportunity emerges near rejected highs. Progress unfolds like a staircase rather than an elevator, demanding patience that respects the arithmetic underlying every campaign. What emerges through this systematic approach is profound identity transformation. The disciplined trader no longer battles market structure through ego-driven decisions, but aligns with the composite man's methodical operations, understanding that sustainable results flow from consistent process rather than perfect prediction. Discipline conquers emotion. Logic defeats bravado, and systematic thinking overcomes impulsive reaction in the arena where character development determines financial outcomes. The 10 golden rules become not mere techniques but the foundation for reading smart money like a book, revealing the composite man's footprints through methodical application of time-tested principles rather than mystical intuition. Those who integrate this systematic approach discover that market noise recedes while the tape's grammar emerges, transforming charts from battlefields of opinion into transcripts of behavior that speak with mathematical certainty. To those willing to learn the patient language of professional campaign management,